we have used the FICO score.
Oh, we're
That-
changing it.
The classic FICO for as long as I can remember. We mortgage people pull a tri-merge credit report with classic FICO score data. FHA announced that they are going to start to use Vantage score and FICO trending data. What does that all mean? Okay, basically the Vantage score, it looks at credit history in a different way than the FICO does. It's a little bit more involved, so it's not just a number and getting an approval. These systems are getting really smart, and they're actually analyzing how people spend their money, how they keep their balances, are they making minimum payments every month, are they paying their credit cards in totality. So our job is going to get more intricate in the sense that we need to be a lot more connected with our clients and advising them on how to be financially responsible, how to prepare to buy a house. This may mean that we have to work with somebody for 3 months prior to them being actually ready to buy, because they are going to have to change the way that they do life, right? If they buy something on a credit card and they let it sit there for 10 months and make $25 minimum payment every month, that's gonna look really bad. Meanwhile, they have $50,000 in their savings account, but they don't pay their credit cards because they don't think it's important. So those things will have to change. But the Vantage score, it uses 35% payment history, 30% utilization, 50% length of credit, 10% new credit, 10% credit mix. So this is just how it reads the information that is there. Now, the Vantage score tends to give you higher scores than the FICO Classic. So when we pull credit now, you have a FICO score and you have your Vantage score. You're getting 6 scores for one client. And most lenders are using the Vantage minus 20 points, which typically is better than the FICO. Okay, so when I pull credit now, I'm gonna have 6 scores as opposed to 3. So I'm gonna have 2 scores for each credit bureau. They make it special. They make it special. And then, what impacts your credit score? So again, people have to be a lot more aware of how they are treating their credit with the new changes. Payment history, very important. Credit card utilization, don't max out those credit cards, that's gonna hurt. The length of the credit history, we need at least 24 months credit history, ideally, for a loan. The other day I had a client, her credit score was 700, but one account was 12 months, another account was 3 months, she didn't have 24 months credit history, so I couldn't get an approval for her at all, even though she had a 700 credit score. Okay?
I guess that would be good for new people moving here.
Yes. So credit is going to become a lot more involved as we move forward. Before it was just a score, but as AI and the systems get very smart, it's gonna analyze people in a different way. And then what is trended credit data? Oh, so the good news is the people with really low score can actually add the utility payments, like light, water, to the credit. And if they pay rent, they can add that to the credit as well, and that's gonna help them qualify. So for first-time home buyers who have been renting for 5 years and making those payments on time, that information is gonna be added to the credit, and it's gonna help increase the history and increase the credit score. So this is, although it's a lot more involved, it's really good for first-time home buyers. Cause that information, yes, cause that information before just wasn't taken into the account, but now it will be taken into account. So a lot more people who didn't have a bunch of credit cards or only had a Capital One credit card for $300 for 12 months, now they're gonna add their rental history and the light bill or the water bill, and now they'll be able to qualify, whereas before they wouldn't be able to. So that's the good part about it. So now let's go to what drive mortgage rates. Mortgage rates change on a daily basis. Sometimes more than once, okay? So what influences interest rates? Inflation, the bond market performance, more specifically the 10-year Treasury bond, the Federal Reserve policy, employment data, consumer spending, and global economic events. If you look at what we are doing today, we're in the middle of a war, inflation is high. On Friday, we just had a job report that actually showed that our economy is strong and growing and expanding as far as jobs. So the more jobs there are in the market, the stronger the economy is. The less likely the feds are to lower rates, and the less likely the bond market is going to perform in the way that is favorable for mortgage rates. Interest rates are like the lever that keeps our economy leveled. If people are spending too much money, inflation goes up, because if I'm selling ice cream, I have an ice cream shop, and I have a line of people outside of my ice cream shop to buy ice cream, that means that I can increase the price, right? Supply and demand. However, if I have the ice cream shop and only 2 people show up a day, and I'm really pressed for clients, then I need to lower prices. So basically, that's what inflation is. When people are spending, when there's too much money in the system, like when COVID happened and people had too much money, they started spending that money, and that's when the bidding wars happened in the housing, because people had too much money. The interest rates were low. The interest rates were low during COVID. It was not a normal occurrence. We lowered the interest rates on purpose because we were scared that COVID was going to destroy the economy. Because people couldn't go to work. So what did the government do? They printed money. They sent us checks in the mail. And with those checks, we went out and we bought houses. And because interest rates were 2%, and we had that money that the government printed, extra money, we were able to offer 10, 20, 30, 40, $100,000 above what the house was worth. And that's how prices exploded during COVID. So COVID was an isolated event. Hopefully it will never happen again. But it gives you an idea of what happens to the balance of the economy. So people were spending too much money. Housing prices were going crazy. So what do we have to do? We need to increase rates to stop people from buying, stop people from spending, so we can keep things level. The financial system needs to be leveled. We cannot be here, we cannot be here, we need to be leveled. And they use interest rates to keep us from spending too much or spending too little. So right now, although it doesn't seem like it, we have high inflation because we're still recovering from COVID and printing money. But we still have a bunch of jobs. We still have money. People are still working. Our economy is strong. We keep hiking interest rates because we need people to stop spending, to bring the prices down, or to moderate where prices go. So this is where we are right now. That's why the Feds they kept on increasing interest rates. So when the war started, we had everything planned out. Interest rates were going to stabilize it. They were coming down. I even did a video saying interest rates are 5.99. Oh my God.
They were for a minute.
It's finally happening. Yay. 2 weeks later, the war hit. Interest rates went back to 7. So it is great when interest rates are really low, because people come out of the woodworks and are ready to buy because they can actually afford it. But we need to put food on the table today, right? We cannot afford to wait forever for interest rates to come down. And the people who need housing cannot afford to wait forever to buy a house. Every day, people marry, people divorce, people die, and their needs for housing,
They have babies.
they have
bigger
babies,
house.
it changes, right? So I can sell interest rates because rates right now suck, and most likely they will continue to be terrible for the near future. I mean, we're in the middle of a war. What can differentiate me and you guys from people who are trying to sell rates or gimmicky stuff is providing solutions. And that's why we do what we do. That's why we communicate. That's why we think outside the box. That's why we think about, let's buy down these interest rates. Let's get a credit. Let's prepare these people for the future. We don't want them to fail. We don't want to fail. So that's where we are with interest rates. Right now, we are closer to the sevens on conventional for rates, 6.875, 6.75 depending on the score. I priced purchase today at 7.125. So it's what we are. So let's say that I am the buyer who is waiting for rates to go down. It was 5.99, I missed my chance. Now it's 6.75. 3/4 of a point is really gonna stop you from making a life-changing event that you actually need, which is to bring your mom to live with you, because she's getting older like we all will. If you have the need, which you're gonna find out if your client has a need or not during your buyer's consultation, right? If your client has the need, then now is the right time. Because we don't have a crystal ball. We don't know if tomorrow rates are gonna be 4%. And if you buy today and tomorrow the rates, we refinance it. It's not a big deal.
But very important, making sure that you're like, if you have a client, you have been waiting for rates to go down. Okay, so in that meantime, have you been saving money? Have you been working on your credit? Those are questions you want to ask. Yes, I have. You know, my credit is good. I paid down below 45, right?
Yeah.
Below 45. We'll just use that one. So my DTI is your DTI. You think below the 45% of your income, right, or your usage? And have you been saving? You know, like they say, yeah, I have $40,000. Now that's not going to get a full down payment and closing costs, but at least you know in your head, okay, I could work with that. Now, if they said, I don't really have money saved, no, then you're not really ready. You're not ready, and you haven't been preparing. So then you know, okay, this person is not ready right now. We need to put them in like the 3 to 6 month category. They're not ready just yet.
How many times can you refinance? Just once?
No, there's no limit.
Like each time when it's go down, you can.
Yeah.
As long as it keeps going lower than what you
Yeah.
have.
Yeah, it needs to make sense because there's cost associated with refinance. So I would never tell a client to refinance every year because it would eat away from their equity. So ideally, you refinance once, maybe twice, because you don't want to lose money either. Going back to refinance,
Yeah.
why would somebody
I mean,
wait?
is there-
Let's say that I bought a house at a 7% interest rate. A year later, the rate is 6.875. It's not enough to refinance. It would be at least a point lower to make sense long term, and for you to recoup the money that you're gonna have, the closing cost that you're gonna have to incur on your refinance.
An average like cost to refinance about $10,000.
Yeah. Yeah, so those $10,000 are gonna be added to your loan. So if you owe $400,000 at a 7% interest rate, now you're gonna owe $410,000 at 6.875% interest rate. It doesn't make sense. So ideally, you wanna lower at least 1% more if you can. That's great, but at least 1%. There's one thing that I learned is you buy and you hold. That's the magic of real estate. You buy and you hold. And financial markets crash and things happen, and then you recover. And when you recover, you come back stronger.